Welcome to this special interview brought by AdviseWise in collaboration with Bentham Asset Management. My name is Samuel Fenning, Director and Advisor at AdviseWise, and today I'm joined by Richard Quin, Chief Investment Officer of Global Credit Manager Bentham. Today we're going to talk about the basics and complexities of the global bond market. Thanks, Richard, for joining us.
Yeah, hi Sam, it's good to be with you today.
Thanks, Richard. Looking forward to getting your insights and experience on a number of questions. Let's start with the most basic question, but unknown for many people. What is a bond?
Yeah, a bond is a fixed term investment that's usually issued for a long period of time. Usually when people say bond, it's short for government bond, but you can have all different types of bonds. And they're usually a frequency of half a year. So they pay a coupon every half a year. And they also can be for very long terms. So you could have a 10-year bond, and companies issue them.
Next question I have for you, Richard, is are bonds and fixed income the same thing?
Yeah, I suppose the difference between fixed income and bonds is predominantly that fixed income is a much broader universe. It includes bonds, but there are also floating rate notes, loans, you can have convertibles, you can have all different types of fixed income securities, and a bond is just one of those types.
Richard, what are the different types of fixed income?
Gosh, there are so many different types of fixed income instruments. You can have government bonds, local government bonds, semi-government bonds, bond world. You can have corporate bonds, you can have corporate loans, you can have convertibles, you can have hybrid securities. There's lots and lots and lots of different types of instruments that are issued by governments and by companies that people can invest in to give themselves an income, a regular income.
Thanks for clarifying, Richard. What are your main considerations when constructing a fixed income portfolio?
Yeah, okay, so the major considerations in constructing a fixed income portfolio, it really depends on what the objective of the portfolio is. So if the portfolio is to match a bond index, we'll match the bond index and make adjustments according to that variation. Generally speaking, we have a lot of more lateral sort of portfolios where we can be a bit more freestyle, and that's an example of that would be, say, our global income fund. In that sort of portfolio, we're looking at what the objective is for the investor. So usually it would be an income objective, like how much do they want to make in a return above cash. And then when we construct the portfolio, we do that by adding lots of different instruments together to give that potential return. Now, the things that we're going to be concerned about are the rating of debt that we're buying. We're going to be concerned about how much we buy. We don't want too much concentration. We're going to want to see a lot of industry diversity. And then we may diversify into different types of instruments as well. We might buy, mortgage-backed securities. We might buy loans. And again, we do that in a relative value concept. And that's how we try and optimize value for our investors.
Building on that last question, Richard, why include fixed income in a portfolio?
Listen, the reason you include fixed income in a portfolio is it helps you achieve your investment objectives. Now, it's not always the hair that gets the result. And a lot of our portfolios have actually done better than Australian equities over a long period of time, 10 to 15 years. So the characteristics of our portfolios and our credit portfolios make it a more interesting return set for someone that can't risk as much capital. So we tend to get more security and we tend to get more consistent income, and it's a legal requirement for us to be paid our coupons.
Richard, what makes one type of fixed income attractive compared to, say, another one?
Yeah, it really depends. Like, we always look at different types of instruments and we look at everything from a relative value point of view. So we're always comparing different instruments, different credits, and usually we're looking at the interest margin you get paid for the level of risk that you're taking. Now, we can measure that level of risk in many different ways. It depends on the seniority of the debt, it depends on the rating of the debt, it depends on the potential upside. It may well be that we're looking at we're looking for higher returns in higher risk funds, so we might be taking more risk in those funds. But generally speaking, sometimes markets and some markets like some style of debt more than they like another style of debt, and people tend to go in trend waves that maybe mean they ignore the value that is in a debt that we quite like, and we may think the risk-adjusted return in that debt is better than another piece of debt.
Thank you, Richard. Appreciate your explanations and commentary on our questions. In this video series part 1, we've addressed the fundamentals of bonds as a fixed income and why and how you should consider them in your portfolio. Keep an eye out for the upcoming second part of our series, thematically speaking. If there are any other questions you would like us to get across, please don't hesitate to contact us. Thanks and bye for now.